Hello, 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 hello. Welcome to our next chapter. Very, 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 very important chapter of customs. If you are leaving the entire customs, I don't care, but please, please, definitely do this chapter. That is valuation under customs. Each exam always has a question from this, and it is easy. We will simplify it to such a method so that you do not get scared of this. Okay, so valuation of custom. Before we start this chapter, there are four terms that you should be knowing. So your first term is your X factory price, that is said. Now X factory price means whatever cost is at the factory gate, the value of goods at the factory gate is your X factory cost. So in this, what all is included? That is your cost of production. Your cost of production is included, and a profit that the producer will charge. This is your X factory cost. Both of these. So your cost of production plus your profit is your X factory cost. Okay, now the moment these goods travel from the factory to the port. They have only traveled to the port. They have not been loaded. They have only traveled to the port. So now in such a case, you will also be paying freight, that is transportation for the good from the factory to the port, plus any local taxes. If any local taxes have to be paid, that has to be added. So that you will get free alongside. Why is it called alongside? Because it is alongside the port. It is alongside. It is kept beside the port. Okay, so in such a case, therefore, it is called FAS, that is free alongside. So that now, if you have to come up with a formula for free alongside, it is basically your X factory price. Okay, it is your X factory price plus your local freights plus your local taxes, and you will get your free alongside. Okay, now these goods are kept alongside these goods are kept alongside the port. Now what do we have to do? We have to put them in the ship. Now the charges you will have to pay, you will have to pay some charges to put these into the ship. That is your loading charges and any export duty. You will be paying these charges, only then will these goods be on the ship, because it will be lifted by a crane, and then it will be put in the ship. So there will be some loading charges. So now this is called your FOB, that is your free on board. Very, very, very important. So if you have to come up with a formula, free on board is equal to free alongside. Okay, here carefully what I'm saying, free on board is equal to free alongside plus loading charges plus export duty, and then you will get free on board. Okay. Okay. Now next is, now these goods are only on the ship. These are on the ship, but these are on the ship of the domestic country. These are on the ship of the domestic country. Now the ship will travel and it will reach to my port because I am importing these goods. Now the moment they reach to my port, before that I will have to pay insurance for this. I will have to pay insurance for this. I will also have to pay transportation because ship will go from one country to my country. So therefore I will pay insurance and I will pay freight. So adding to FOB, when you add insurance and freight to FOB, you will get your cost insurance freight, that is your CIF value. Okay, this is your CIF value. So please, please, please do not have any confusions in this. Please get your concepts very clear. If the faculty video that you've been watching, if those were not clear to you, this is your entire cycle. This is your entire cycle of how goods happen, of how goods flow from one place to another, and what terminology is used. So X factory price, free alongside, free on board, and your cost, insurance, and freight. Okay, so your cost of production plus profit will give you X factory price. Your X factory price plus your local freight plus your local taxes will give you free alongside. Your free alongside plus your loading charges plus your export duty will give you free on board, and free on board plus insurance plus freight will give you your CIF value, that is your cost, insurance, and freight. Okay, now coming to the valuation part. Valuation part is a little tricky, but it is very much manageable. So under valuation, that is your rule 3. So it is under rule 3, that is value of goods. Value of goods for the purpose of importing your duty, for the purpose of calculating duty. It is the transaction value, that is the value at which the transaction has already taken place. Plus there are certain adjustments under rule 10. There are two types of basic adjustments under rule 10. So there are, one is mandatory adjustments and second is adjustments only if actually incurred or only if actually given in the question. So your rule 10 is divided into two. That is your 10(1) and 10(2). Now what you have to remember, your 10(2) is your mandatory adjustment. That means even if this information is not given to you in the question, even if this information is not given to you in the question, these two adjustments you still have to do. So how do you remember? 10(2) has two adjustments. One is with regards to freight and other is with regards to insurance. 10(2) is your mandatory adjustment. Okay, I will give you all the ways you have to learn. Mandatory adjustment, two are your freight and insurance, and 10(1) has seven adjustments which have to be adjusted only and only if they are given in the question. Okay, so now let's do first our mandatory adjustments. Your mandatory adjustment with regard to your freight and insurance. Okay, so 10(2) is first of all freight. So you have to add actual cost of transportation to be added. Actual cost of transportation has to be added. It also includes your barge, lighterage, demurrage charges, but does not include transshipment. Now, what are barge, lighterage charges? So, for example, when a ship is too huge to come to the port, what happens is smaller boats, lighter boats are sent to the bigger ship. They carry the goods on them and then they come to the port. So therefore, since these are called lighter boats, therefore this charges you have to pay to the boat because your ship is too big to come to the port. So therefore, these charges that you pay is your lighterage charges. Okay, your homework is to find what is demurrage charges and what is barge. Google it and you will find it. Okay, pause the video, Google it and find it and come back. Okay, transshipment means transportation from one port to another port within India. That is transportation within. Once it has already reached India, these costs have not to be added. Therefore, transshipment is not added because it has already reached to the port of India. Any movement from one port to another port will not be considered. Okay, now another thing that you have to remember, if it is air freight, if the goods have been transported through air, you have to restrict it to 20% of FOB. 20% of FOB. That means, for example, if your free on board comes to rupees 1000 and your transportation comes to say rupees 3000, you will not be adding 3000, you will only add 2000 because 20% of FOB, that is your maximum limit. It is only and only in case of air freight. Okay, only in case of air freight this 20% limit is applicable. Okay, sir, but what you told us that these adjustments are mandatory. What if they have not given us any information in the question? If they have not given you any information in the question, or if they have told you that freight charges are unascertainable, that means it is not easy to find them. We are not able to ascertain. In such a case, so when freight charges are unascertainable, when it is not known or when it is not given in the question, in such a case, you will assume 20% of FOB. You will assume 20% of FOB. So what do you have to remember? Your freight charges maximum is 20% in case of flight. Okay, that is maximum. It is not equal to. If your flight charges is, for example, 1200 and your goods value is 10,000, then your maximum limit is 2000. But you, how much have you spent? You paid only 1200. So only 1200 will be added. Therefore, this 20% is an upper limit. But if it is unascertainable, then you have to flat add 20%. That will be your freight. Okay, this was your freight. Second is your insurance. Insurance, actual cost of insurance to be added. Okay, sir, what if insurance is also unascertainable or we are not able to find? So you will assume it is 1.125% of your FOB. Remember, it is FOB. Now, why did I tell you this term? Because everything we are focusing on your FOB only. Just a second. Okay, so over here also we are focusing on FOB and over here also we are focusing on FOB. So please make sure if in the question, if in the question they've given you CIF or if they've given you FAS, so you have to calculate FOB and then you have to put these percentages. Okay, so 20% in case of freight and 1.125% of FOB in case of insurance. So these were your mandatory adjustments. Now there are some adjustments that you have to add only and only if they are given in the question. That is your rule 10(1). Rule 10(1) has 7 adjustments. Rule 10.1 has 7 adjustments. These have to be added. These have to be given effect only and only if they are given in the question. First is your commission or brokerage paid by your I is your Indian importer. So wherever I have used I is your Indian importer and FS is your foreign supplier. I have written it over here also. I is your Indian importer and FS is your foreign supplier. Okay, so any commission or brokerage paid by Indian importer to be added. Any commission or brokerage that is paid is to be added except if it is buying commission. Buying commission does not have to be added. You have to ignore. They give you this point a lot of times in the exam. Please make sure you remember. Buying commission does not have to be added. Say it with me. Buying commission does not have to be added. All commission brokerage paid by your Indian importer has to be added except your buying commission. Next is your packaging charges. Packaging charges paid by your Indian importer to your foreign supplier to be added. If this is given in the question, you add it. Next is your cost of raw materials, spares, consumables supplied by your Indian importer to your foreign supplier free of cost to be added. Because what happens, for example, if I've told my foreign supplier ki boss, I need a machinery made of steel. So to reduce the cost so that I have to pay less import duty, what do I do? I'll tell him that boss, I'll export you the steel. I'll give you the steel. You use the steel and give me the machinery. Don't charge me for the steel. I'll give the steel to you free of cost. Okay, now this value that he will charge me will be very less and I will save on custom duty. So therefore this has to be added back. So anything that the anything that the Indian importer gives to the foreign supplier free of cost, in such a case, this has to be added. Next is your cost of design or drawings. Any design or drawings that are supplied by your Indian importer to foreign supplier free of cost to be added. Only and only if such work was undertaken outside India. Excuse me. So only and only if this drawing and design work was undertaken outside India and it was supplied by your Indian importer to the foreign suppliers free of cost, only then it has to be added. Remember, it has to be done outside India, because if it is done inside India, it is not an import. You are not importing only. If only and only if it is done outside India, only then you have to add. Next is royalties and license fees paid by your Indian importer to foreign supplier as a condition of sale. Condition of sale means this has to be done. Only then will the sale be considered as complete. So therefore, any royalty or license fees paid by your Indian importer to the foreign supplier as a condition of sale to be added. It has to be added only and only if it is compulsory. That means if it is an optional payment, it need not be added. It need not be added. It need not be added if it is under a separate agreement. If there is a separate agreement for this, you need not add. Or if it is paid for reproduction of imported goods in India. If you are making this payment for doing production in India, you are producing these goods in India and then you are paying them a royalty fee, then it need not be added. But otherwise, any royalty or license fees paid by your Indian importer to the foreign supplier as a condition of sale has to be added only if it is compulsory, and in two cases it need not be added. That is, if there is a separate agreement and if production of imported goods in India. Next is part of proceeds of subsequent resale, use or disposal of imported goods paid by your Indian importer to the foreign supplier to be added. That means, for example, you have entered into a deal that boss, this machinery that you are giving me, you give me only for 10 lakhs. Then after 5 years, I will sell this machinery for 1 lakh, and this 1 lakh also I will give it to you when I sell it. Okay, so therefore, this is actually a payment only, just you will defer it. So therefore, this payment also has to be added. This 1 lakh will also be added to the transaction value of 10 lakh and it will come to 11 lakh. Next, any payment as a condition of sale. Condition of sale means which is compulsory to effect the sale, paid by your Indian importer to the foreign supplier has to be added. So these are your 7 adjustments. These are your 7 adjustments which have to be added only and only if it is given in the question. This is your rule 10.1. But those under rule 10.2 have to be mandatory to be added, because those are mandatory adjustments. Okay, so we are now coming to your next rules. So these are very, very simple, nothing to worry about. So they say when you are not able to identify, when you are not able to identify the transaction value, you remember we did rule 3. All of this that we were studying was rule 3. Now we are doing rule 4. That is value of identical goods. So that means if you are not able to assess the value as per rule 3, what do? You take the value of identical goods. You take the value of identical goods. That means goods that are sold which are identical to yours in the market. You take that value, that will be considered as your transaction value. Rule 5 talks about value of similar goods. Similar goods might be different in some certain conditions, but very close to each other. That is imported at or about the same time, sold at the same commercial level and quantity, and in case it is less than one transaction value, in case sorry in case there is more than one transaction value of identical or similar goods, in case there is more than one transaction value, use the lowest one. The lowest one will be considered. Then your rule 6 talks about rule 8, then rule 7 can be followed. So rule 6 gives you an option that instead of going line by, that is, first we did 3, then if you're not able to do as per 3, then you do 4. If you're not able to do as per 4, then you do 5. So this goes in a chronological order. Rule 6 says that it is not necessary that you first have to do rule 7, then you have to do rule 8. You can also do rule 8 first, and then you can do rule 7. Okay, so what does your rule 8 say? Rule 8 says computed value, that is cost of manufacturing in foreign country plus transportation cost in foreign country plus your rule 10 to adjustments. 10 to adjustments are your mandatory adjustments, plus your gross profit for your foreign supplier. This is your computed value. So basically you start from cost, add any cost that are incurred, you add his profit also, and add your 10 to adjustment. That will be your value that we will consider. And rule 7 is your deductive value. Rule 7 says price at which identical or similar goods, price at which identical or similar goods are resold in India. That means in the Indian market, what they are priced at sold, at what price they are sold in the Indian markets, in greatest aggregate quantity. In greatest aggregate quantity, of course, maximum, higher the quantity, more trustworthy the price is. Now from this you will subtract your GST and local taxes, because what do you have to do? You have to find the value of these goods that are being resold in India at the time when they were imported into India. That means at the port of India. So therefore all the expenses that are incurred to sell these goods, all of this will be subtracted, so that you get the cost of these goods at what these costs would have been when they were at the port. So you will subtract any GST, local taxes, any freight or insurance that have been paid within India, any custom duty that have been paid, any gross profit margin expected to be earned in India. So in this case, we are going in a reverse order. That means selling price minus all cost minus profit, and you will get the cost at which they would have been imported into India. Okay, so 10-7 goes in your reverse order, and rule 7 goes in your reverse order, and rule 8 goes in your forward order. That means cost, freight, insurance, everything will be added. That is how rule 8 computes. And rule 6 says you can either use rule 7 first and then rule 8, or rule 8 first or then rule 7. Okay, and this such a easy chapter, and we are done with your valuation under customs. Do solve questions of this very, very important chapter, and I will see you in the next video.